morning. Welcome to the Point. It would be, and maybe I'll be corrected on this in just a moment, but it would be the most significant legislative achievement that Republicans would have since the election of last year. It would be tax reform, but it is not done yet. To talk about the very latest about that, Congressman Bill Huizenga joins us. Congressman, first of all, thank you for being here.
Yeah, pleasure.
Before we start, I want to be very clear that as we talk about this, we're 48 or so hours from the time that this airs. We believe, or at least you believe, that the form that we're going to talk about is pretty much what the final form will take. So we're going to talk about the plan to change taxes in the most significant way, at least since Ronald Reagan, if not since perhaps John Kennedy, depending on what ultimately comes out of this. So let's start. The bill has been largely finalized now?
Yeah, we believe so. We've been told that it will be filed on the floor, which means it will be officially introduced this afternoon. And we've gotten some good feedback from what has been out there, but it's been fine-tuning some details. And you saw that recently where corporate rate went from 20 to 21%, for example, down from that 35%. You know, things like that. One of the last issues that was dealing with the refundability of a per-child tax credit. Senator Rubio was wanting to increase that refundability, meaning if someone's not having to pay taxes, that they would actually get part of that part of the tax bill back, even if they haven't paid anything in. So there's some significant benefits, we think, to low and moderate income folks.
Part of this is about getting to 50 in the Senate, because over in the House, unless things changed really dramatically, you probably can pull enough votes together. The Senate's a different story, and you've got some members who are out. There are some members who are on the fence. But again, as we say, and I said about 40, it's about 36 hours.
Yeah.
It looks
and at this point, every hour counts.
Well, that's right.
It does.
So by the time this airs, this could have changed. But if the form of the bill, as you understand it, stays roughly where it is, and if the members stay roughly where they are, then the odds of this happening are greater than I would have given them just a couple of days ago.
Well, you know, actually, I think the toughest hurdle to come over was actually getting a bill of any sort passed in the House and in the Senate. And I think it was frankly harder in the Senate, because once you've sort of pierced the veil, you know, once you've decided that, you know, if you're in the pool and you're wet, you might as well start swimming, to kind of mix some metaphors. I think that was really the most difficult step for them to take. Now that it had passed the Senate and had passed the House, then we're talking about details. Some not insignificant details, but details. And the idea that we need to move forward with this had become a settled point. Because there had been some in the Senate who had been saying kind of quietly behind the scenes, you know, let's just do something real small, moderate, you know, maybe a kind of a 5% across the board cut, and we'll just put this off and live to fight another day. And a lot of us were looking at it saying, this is our opportunity to go and be bold and to be kind of frankly straightforward with what we said we would do. You know, 2010, when I started campaigning for this job, and in that election, tax reform was an issue then, and there's no reason for us to be waiting and putting this off for another day. The day has arrived.
So what does it look like? Let's talk about rates and those different tax brackets, because many people could not tell you exactly what bracket they are in right now. And the same was true when you were in the House of Representatives, State House of Representatives, and there was a big question about changing the tax bracket. And I made the case at that point, you could walk down any street in the state and you couldn't get 1 in 10 people to tell you what the rate was. However, people are sensitive to the fact that the tax rates will change. The characterization has been, as you know, by your opponents on the other side of the aisle, that this is a tax cut for the rich. So let's talk about the brackets and let's come to that perception.
And I want to address that
Sure.
part. You know who I'm hearing from the most? people who are rich, that they, like in New Jersey and California and New York, because of my financial services committee work, I get to New York on a pretty regular basis, and they wanted to talk about that, and they were the idea of what a lawyer in New Jersey who's making $600,000 a year, whether they're going to be able to deduct all of their property tax or only $10,000 of their property tax was a big deal to them. So, and my point to them, I said, I don't mean to offend anybody here, but you guys are in that upper bracket of the income where we really need to focus this on is on that middle income and that lower middle income. That's why we're doubling the standard deduction. That's why we're lowering the rates. That's why we're trying to make sure that that hardworking, especially small business folks that are dealing with pass-throughs, that could be literally the pizza parlor on the corner or a dry cleaner or a small CNC shop that might be behind someone's house, that they're the ones are really going to be able to take some advantage. There's kind of a little bit of a cliff or a jump maybe as we're sitting here today. It looks like for married filing jointly, 24% tax bracket would be from $165,000 to $315,000. That takes in a lot of people. That next step is at 32%. So that's an 8% jump, and that's going to be for people between $315,000 and $400,000. So there's going to be some folks that are in that definitely upper income that may not be seeing quite as much relief, but we're really trying to focus it in a couple of very narrow areas. Low and moderate income folks, trying to make sure that with per child tax credits, doubling standard deductions, those kinds of things, that they really are able to keep more of their money. Trying to make sure then that we are dealing with those pass-through businesses. Those are the LLCs and the subchapter S corporations that literally dot West Michigan on every corner. I mean, that's been the engine of what has made West Michigan so unique, that entrepreneurial spirit. And then here's the big thing, and something that frankly the Reagan tax rates didn't really, or those cuts didn't really go after, which is the corporate side. Lowering the corporate tax rate from 35% down to 20% was the initial goal. It's been brought up to that 21%. We've got $3 trillion of money that is offshore right now that needs to come back here. That's going to be one part of that, and lowering that tax rate for our corporations is going to make sure that the Paragos of the world don't become Irish, that they stay and become and stay American. And that is the only way really that we're going to be able to remain competitive through our tax rates and our regulatory reforms.
I want to talk about the idea of bringing money back on from offshore, but first let's just one more thing. The top rate in the individual does come down a little bit. It's 39 something, right?
39.6 currently.
And that would, under this plan, as we sit here and speak, would be at 37.
So, but it's a little different right now. It's 39.6 for anyone making $500,000 or more. That moves up to $600,000, but that does drop from that 39.6 down to 37%. So,
all right, let's talk about that corporate rate and how do you get that money to come home? Is it just a matter of lowering the rate and it will magically happen, or is there some kind of a carrot and stick?
Yeah, there's a special one-time provision in this that says if you are going to take this money that you've earned overseas, that you've paid overseas taxes on, if you bring that back here to the U.S., you'll get charged 10%, I believe is the number. And then at that point, that means $3 trillion offshore will directly put $300 billion into the U.S. Treasury, plus put then that remaining 2.7 trillion with a T trillion dollars back into the business community that's going to look at investing it, look at building new plants and hiring new people and buying more equipment. So we think that there's a double bonus here. Increased economic activity and actual direct infusion of $300 billion into the U.S. Treasury.
Talk to me about the optics of this. Again, that corporate tax break is part of what the folks on the other side say, well, look, you're giving these corporate fat cats this big tax break. And at the same time, they're saying that it will hurt people in the middle. It will hurt people at the lower ends because the standard deductions go up, but some of the deductions go away, right?
Well, you have to look at this Byzantine tax code that has been created over the last 36 years that is just full of holes. It's Swiss cheese, really, because you've had the well-connected and those who can hire lobbyists, whether it's on a corporate level or on an individual specialized level, who've gone in and carved this thing up. So to really make it flatter and fairer, we had to eliminate a good chunk of those itemized deductions. By the way, it's only a fairly small portion of tax filers that actually itemize, but we preserved a couple of key things. One, interest mortgage deduction, that up to $750,000. The initial House version had $500,000. The Senate had been where the current law is at $1 million. That's getting lowered down to $750,000. That covers like 98% of all mortgages, if not more, that are out there. So we also preserved your deductions for charitable contributions. We think that that's an important thing to do. So there's a couple of those small, very specialized kind of deductions that would remain for everybody if they itemize. But let's get to this corporate thing. So amazingly, even President Obama had recognized that at 35%, the U.S. corporate tax rate was uncompetitive. He had suggested a 25% tax rate. Again, the House had come in at a 20%. We're finalizing it at 21%, so it's 4% below where President Obama had said that it should be, which is very believable. Had we been negotiating this with the Obama administration, we very well could have ended up at 20 or 21 or 22% anyway. So I think this is right down the center of where it should be. Still won't be as competitive as a lot of other countries, but we think that with our regulatory reform and some of the other things that, low energy costs here in the U.S. and those kinds of things, we still are very attractive internationally.
I want to talk more about this. I know you work on Financial Services Committee, and that's sometimes hard to explain, but we'll try to do that next when we come back to The Point. Welcome back to The Point. This morning we're talking about a big bill in Congress that could be a major legislative achievement, at least for Republicans. It's tax reform. Congressman Bill Huizenga is here to talk to us about it. I want to talk to you about some of your work on the Financial Services Committee, because that impacts a lot of folks. But before we move off tax reform, final question. When President Obama was candidate Obama, he railed against the deficit.
Yep.
When President Obama was President Obama, Republicans railed against the deficit. If this tax bill passes, what does it do to the deficit?
Yeah. Well, let me add one caveat. Some of us have been railing against the deficit no matter who's president. And I find it interesting. There are some of my colleagues that have found religion on this. They had no problem spending $1.5 trillion per year adding to the deficit, but they somehow magically believe that if the government is spending it versus you and I as individuals or our neighbors who might own the pizza parlor or a corporation spending it, then somehow that's a bad thing. It just doesn't pass the sniff test to believe that we are not going to have economic activity coming out of this. I recently talked to an economist. That's one of the things I get to do being on the Financial Services Committee is I sit in front of banks of economists sometimes. And one of this economists with a major insurance company had said, look, I think this is going to be a broad-based stimulus, this tax cut, because it's a broad-based tax cut. And that's the idea of that. We want to make sure that sort of every nook and cranny of our economy is receiving benefit from that. And when it does that, we are going to see increased revenue coming into the federal government. We're going to see an increase in wages. We're going to see an increase in investment. And at the end of the day, that's a key element of this. One of the things that was a problem in the 1986 tax rewrite was that they then didn't go in and work on the spending side. We've got to continue to do that. This is not just a one and done kind of a thing. We still have to go in and have the courage to talk about what we're going to do with Social Security and Medicare. What are we going to do with other entitlement spending? What are we going to do about our defense spending and our non-defense spending? How are we going to make sure that we rein that in as well to make sure that we can start paying off some of that $20 trillion in debt?
Because the interest on the debt becomes a large line item.
Yeah, in 10 years, in 2028, CBO has estimated that interest on the debt, just with interest rates returning to the norm, interest on the debt will be more than either defense spending or non-defense spending. I mean, that means we're not going to be able to fund whether it's missile technology or whether it's road funding. We're going to have over a third of our entire budget eaten up purely on interest on the debt, which is spending right now. So we have to do this in the economy to try to grow it and stay competitive. And I had, I've had some folks that have been critical of this, saying, our unemployment is low enough, and the economy's cooking along just fine. So why in the world would you want to add tax cuts to that? And it's like, well, because I don't want these companies having another reason to go to a different country, and I want to make sure that we remain competitive on the world stage because we're falling behind.
Financial services, it makes it sound like you run a bank, and kind of you do in a way, or at least you have a lot of input with banks. Yeah. What does the Financial Services Committee do, as briefly as you can? And then talk about, you guys have passed, what did you tell me, 60 different bills have come out of committee in the relative past few weeks, which is a whole lot.
It is a lot, and ironically, it used to be called the House Banking Committee. They still call it the Senate Banking Committee. They've added a few other things to it, though. We regulate all the insurance companies, for example. All of the regulators, whether it be the Securities and Exchange Commission, all the accounting standards, the CFPB, for example, all falls under our purview. Last term, I chaired the Monetary Policy and Trade Subcommittee. I had oversight of the Federal Reserve. So when we were going in and having Janet Yellen, Chair Yellen, come in, they were coming into our committee and explaining what was going on in the economy. I now chair something called the Capital Markets, Securities and Investments Subcommittee, which is the largest of the subcommittees. And we have oversight of New York Stock Exchange and NASDAQ and all the other exchanges. By the way, there's 21 of them that are chartered here in the U.S. That are national markets. I've got all of the accounting standards that fall underneath that. The main thrust of it, though, is trying to make sure that we've got capital markets that are working so that we have investment happening here in the U.S., both domestically and internationally, how those fit together. It's the regulators. For us as retail investors, how are we being protected? And then those institutional investors as well. How are we making sure that the markets are running along? So you and I might go and buy a single stock, but it's when we're putting money into our retirement funds, those institutional investors take all of groups of people's retirement dollars, and they start investing it on a much bigger scale. And so there's a lot of very technical detail, but it's been fascinating. I've really enjoyed it.
When you talk about tax reductions, because it's a little hard for people to quantify that. My contention is that most people don't know what their average rate would be. But
all they know is they're paying too much.
Well, that's right.
Honestly, that's what they feel.
And it's pretty easy to see every week or every 2 weeks when you get your check, and you know that there's a lot being taken out. So at least there's something there that's somewhat tangible. When you talk about financial services, you explained it. It's about our investments and the way these things work. But it is kind of this detached idea because people don't deal with this on a day-to-day basis. Talk about some of the bills that have moved out of that committee that might have a direct impact on some of the people that are watching.
Well, and here's where it really intersects with them. I've got a mortgage. I assume you have a mortgage. A lot of people have car loans, or they might have a home loan that is allowing them to invest into a small business. our community banks, our credit unions, our regional mid-sized banks, as well as the big, the big five as they call them, the super big banks, they all fall underneath that purview. And so when you and I are going in and trying to open up a free checking account, which, oh, by the way, they no longer offer because of that regulation, or when we're getting turned down for a mortgage or turned down for a car loan because of new rules and regulations that have been put in place, it becomes real. And so that's also kind of what we have been getting at. Those 60 bills that came out, or nearly 60 bills, was kind of the Choice Act, which was our response to the Dodd-Frank Act, sort of now getting kind of pulled apart into different pieces. I had a couple of pieces of that. One of them having to do with mortgages. It's called the Mortgage Choice Act, and how you buy your title insurance when you are going in and buying your home, and how that operates. So we're trying to streamline that, for example. Another one that came out unanimously out of committee and actually then went to the House floor, where we had 426 votes for it, including all the Democrats on the Financial Services Committee. Has to do with mergers and acquisitions of small family-owned businesses. So this might be the LLC that could be running an auto repair shop, or again, that pizza parlor. And if you are wanting to buy that and pass that along, then you actually technically fall underneath securities laws. And it's very expensive to do those. And they've kind of turned a blind eye to smaller businesses being handled by these small business brokers. And sometimes it's a realtor who's going in and saying, hey, you're selling your business and the building and all the equipment that's going to go in there. Technically, that could violate the law. And so we're trying to go in there and restore some kind of common sense things to make it easier, because there's an estimate of $10 trillion that is tied up by baby boomers who are getting ready to retire. And there's only going to be a couple of things that are going to happen with those businesses, Rick. They're either going to pass them along to their kids, they're going to sell them to someone else, or what I think is the worst thing that could happen is they shut them down. Because they don't have the ability to pass it along and to sell it to that next generation of entrepreneur that wants to buy it.
We've got a couple of minutes left, and I don't want to put you out there on the limb, but it dawns on me that interest rates have started to go up a little bit, and the Fed, and I know you interact with them as you were just talking about. That generally would indicate that the economy is getting a little stronger, and the Fed likes to keep interest rates so we don't get spiraling into some kind of inflation. What does that say to you when you go up that quarter?
Yeah, the Fed had predicted at the beginning of this year that they would have 3 interest rates increases. That's a quarter point each time. We are still at historically low interest rates. I would argue that they are artificially created low interest rates through quantitative easing and some things that the Fed has done over the last decade. So we've got to return to normal, Rick, because if we don't, next time we see an economic downturn, which is inevitable, it will happen, all the tools are being employed right now to try to keep us at this artificially low interest rate. And so we've got to have things like wages increase, to have that economic stimulus continue. We've got to have a normalcy return to things like like interest rates. And so it's not anything that we should be afraid of. And I read a headline, interest rates on credit cards going up. It's like, okay, well, it may go up a quarter point, may go up, but not necessarily. And so you just see kind of people, I think, trying to get headlines out there.
I've got less than a minute. Yeah. I hate to leave you with this short period of time. Okay. Net neutrality, good, bad, has it changed significantly?
Oh, well, so what had happened in 2015 is you had 1934 utilities law applied to the internet. It just doesn't make sense. And you saw the FCC say, you know what, we're gonna peel this back here. And now it's up to Congress to put it back in its place, where the Federal Trade Commission has the experience and the ability to regulate this. And now we've got to ensure a free and fair and open internet. And Congress is going to be be doing that. We're going to be working on that.
And that may happen even this coming week.
Even this coming week, it looks like we're going to be having that on throttling and other things, making sure that that doesn't happen.
All right. Congressman, thanks very much. We're back with more To the Point. So this week in Washington, Republicans may make good on one of their bigger campaign promises. In what should be the final week of session for the year, they'll try to get tax reform. The question is, will they be able to put up the votes, particularly in the Senate? That's something we'll be watching very closely. We'll also be keeping a close eye on what's going on here in Michigan as we prepare for a very important election cycle in 2018. Next week, we'll go back to introducing you to some of those candidates, and we'll continue to talk about it between now and next November. We'll see you next Sunday. To the Point.